Let's talk about shares, and let's do it fast because time is precious and I'm sure you're all very busy. Let's start with the terminology. Owning shares means owning a piece of a company. Sometimes people use the word stock instead of share. They both mean the same thing. Stock is an older terminology that's still used in certain documents and some definitions. An owner of shares is called a shareholder or stakeholder. Buying and selling shares is called trading shares. Where shares trade is called the stock exchange. The reason why there may be more than one stock exchange is that each one may specialize in a different type or size of company, or one may only trade commodities, derivatives, or what have you. The market where one can buy and sell shares is called the stock market. Let's carry on with the terminology. One hears of people going long or short shares. Going long shares just means buying shares. Going short shares means selling shares that you do not own. So how do you sell shares if you don't have them? The answer is that you borrow shares from certain large owners called stock lenders in a transaction that's called a stock loan. You then sell the borrowed shares and receive cash. You must pay a daily interest on the value of the shares borrowed and return the same number of shares at maturity. At maturity, if the share price is lower, you buy back the shares more cheaply, return them, and keep the profit. If the share price is higher, you pay more to buy the shares back, so you lose money. Usually, only financial institutions and very sophisticated investors engage in a stock loan. If you go to your high street bank and say, hey, I want to short some shares, they may tell you that they do not offer the facility. How does one identify a share or other security? One way is using tickers. These are security identification codes, which are 3, 4, or 5 letters or digits, which were first introduced by the New York Stock Exchange to simplify referring to securities. The largest providers of electronic financial news and data are Reuters and Bloomberg. These are private companies. Reuters uses its own codes called RIC, which stands for Reuters Instrumental Code, to identify securities. For example, the RIC for Vodafone listing in London is VOD.L, with .L referring to London. Reuters RICs can be used to trade shares. And then there's Bloomberg. Bloomberg also uses its own codes called ticker. The ticker for Microsoft trading in the US is MSFD:, US. Bloomberg tickers can also be used to trade shares. Securities in different countries are traded using global or national identifiers. The most global and the most famous is the ISIN number. It's used for trading and settlement purposes. The ISIN code is a 12-character alphanumeric, that means letters and numbers, code, which you can see on the website of the organization at www.isin.org. For example, the ISIN code for Amazon is US 0231351067. Please take note of the numbers in blue because you will see how this changes with other kinds of security identifiers. The second one we want to talk about is QSIP. This is a numbering system widely used in the USA and Canada. It uses a 9-digit alphanumeric code. For example, the Amazon QSIP is 0231351006. Now compare this with the ISIN number. You see that there's a US that goes in front and a number 7 has been added to the back. Then there's CEDOL. This is a 7-character alphanumeric numbering system used for securities issued in the UK. For example, the CEDOL and ISIN for the HSBC Bank are 054058 and GB0005405286. Then there's Valor or Valoren. This is a securities number with 6 to 9 digits widely used in Switzerland and Liechtenstein. Valor and ISIN for the Swiss pharmaceutical company Roche are 12032111 and CH0012032113. And then lastly, there's WKN. This is a German securities numbering system with 6 digits or capital letters, excluding I and O to avoid confusion with 1 and 0. It is likely to stop being used in the near future. The WKN and ISIN for the German car manufacturer BMW are 519000 and DE000 519000 Compare the two numbers with one another. You see that one's embedded in the other one. One often hears in the news that a certain political or economic event is likely to have an impact on particular sectors or industries. GICS, which stands for Global Industry Classification Standard, is an industry definition system developed by MSCI and Standard & Poor's to help the financial community group shares. The groupings allow investors looking to invest in particular sectors or industries to easily identify shares in that group. These classifications have also contributed to the development of many new securities, such as ETFs, focusing on specific sectors or industries. Shares are divided into sectors and industries. The GICS definitions start with sectors. There are 11 sectors, which include energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. Underneath the sectors, there are 25 industry groups, and underneath them, there are 74 industries. And below those, there are 163 sub-industries. You don't need to get into all the details, but you need to be aware that these sectors and industries exist, and it is possible to screen shares based on the sector, industry group, industries or sub-industries that you're interested in. There's quite a few more terminology that you need to know about shares. First is shares outstanding. This is the total number of shares that a company has issued. It's also called shares out. A company can purchase its own shares, and this is called a share buyback. In some countries, when a company buys back shares, it has to cancel them, so the total number of shares goes down. In other countries, it can keep them as what's called treasury shares to sell later back into the market or to cancel. Issuing more shares or buying back shares normally changes the price of the shares. The value of the company should not change, so if the number of outstanding shares goes up, its share price should go down to keep the value of the company the same. If the shares are bought back and cancelled, the price of the shares should go up because there are now less shares altogether. Market capitalization or market cap means the total value of a company as measured by its share price. Market capitalization is calculated by multiplying the number of shares outstanding or the number of shares that the company is issued times its current share price. So the market capitalization changes every day. You would regularly hear the following expressions, so it's important to know what they mean. Mega cap. These are companies with a market cap above USD 100 or 200 billion. Large cap. These are companies with a market cap above about US dollar 10 billion or equivalent. Medium cap. These are companies with a market cap between $2 billion and $10 billion or equivalent. Then there are small cap companies with a market cap between $200 million and $2 billion. Then there's the expression blue chip. These are large cap, well-known, financially stable companies with good cash flows and stable dividends. Blue chip companies have usually been around for a long time. Let's quickly rush through some more terminology. Free float. This is the percentage of the issued shares of the company that trade freely on the stock markets. So they're not held by some insiders that would never sell them, etc. Average daily trading volume, or ADTV. This shows the average number of shares that trade, that means buy or sell, every day. ADTV is usually calculated over a period of time. It could be a week, a month, 6 months, or a year. The higher the ADTV, the larger the number of shares you can trade without affecting the market price. ADTV is viewed as a measure of the liquidity of the shares. Then there's dividend yield. This is a number that shows what the company pays to shareholders every year as a percentage of its current share price. Dividends usually paid once, twice, or 4 times a year. So you add the 4 together, divide by the current share price. And that's your dividend yield in percentage. As the share price changes, it changes the dividend yield. Earnings per share. This is a measure of the profitability of the company. It's calculated by dividing the net income of the company by the total number of shares issued. Then there's price earnings ratio, or PE. PE ratios are used to compare shares in the same sector or industry group. A share with a lower PE than the historic average for the sector would appear cheaper. It's calculated simply by dividing the share price by earnings per share. And then there's PE to earnings growth ratio, which is also called the PEG. This ratio takes the PE calculation one step further by dividing the PE by the expected earnings growth rate. Different researchers may come up with different earnings growth rates, so PEGs reported by different banks and financial institutions could be different to one another. An equity index or share-related index is a collection of shares that are grouped together using a particular method or other to be able to follow the entire market in a particular sector, industry, region, or country. An index allows you to see an averaged economic picture of a sector, industry, or country in one shot. Indices have been helpful to the development of ETFs that allow you to buy all the shares in an index by buying just one security. There can be ETFs on all kinds of indices, including indices that are made up of bonds, so it's not exclusive to shares. If you know about shares and follow the markets, I'm sure that you've come across a lot of these large world equity indices. I'll go through the list very quickly. There's the S&P 500, which is an index of the 500 largest US listed stocks. There's Dow Jones Industrial Average, which is made up of 30 large US listed stocks that reflect the US markets. There's Nasdaq 100, which is comprised of 100 largest stocks listed on the Nasdaq exchanges. There's Nikkei 225, which is made up of 225 largest stocks listed in Japan. There's Eurostoxx 50, which is made up of 50 largest stocks in the Eurozone. There's Stoxx 600, SSE, which relates to Shanghai Stock Exchange. There's FTSE 100, which is the UK listed companies list. There's CAC 40 for France, DAX 40 for Germany, IBEX 35 for Spain, SMI 20 for Switzerland, FTSE MIB 40 for Italy, PSI 20 for Portugal, Nifty 50 for India, and Hang Seng for Hong Kong. I can never decide which financial center has the most beautiful view in the dark. Can you?